Hello, this is Richard C. Wilson from the Family Office Club, and we're going to do a podcast interview. We're also going to be releasing this on YouTube, and it's with SL Vander Zanden. Welcome, SL.
Hello, good to see you, Richard.
SL runs a firm called Caprock Real Estate, and they're focused on retail real estate investing and he's specifically equipped with distressed real estate investment experience. So I just want to give you a minute or two to introduce yourself a little bit further, SL, and then we can jump into the questions that I have here today.
Sure. Okay, something that's come in handy that most people don't know about me is that I'm a CPA because I had an accounting degree coming out of college, which over the last 12 years, as we'll talk about, I've been a receiver on at least 100 assets, and having that background helps especially when you have a bad actor as a defaulted borrower where they play with the books. And, I can usually decipher that pretty quickly and help the lender get their arms around whether it's a bad asset or just a bad actor. So 12 years ago was 2008, 2009, and obviously that was the beginning of the crash. We started our business then, and we went through the entire cycle. I mean, we still have a few now, but in the last few years, we built up a third-party portfolio that we manage for investors from outside the Midwest, coming here, from the coast where the cap rates are lower. So,
Sure.
our focus is turned into be retail, as you mentioned. Out of the 5 million feet we've done so far, 3 million feet is retail, and about 1 million feet each of industrial and office, and 1,000 in multifamily units. So, and our footprint is the Midwest, the Central U.S., whatever you want to call it. We're headquartered in Chicago, so it's draw a big circle around it, and that's where we do business.
Sure, sure. So I've got a lot of questions for you that I'm curious about. First off, though, I want to make sure I don't confuse or lose anybody when it comes to a couple of the terms. So the first term is receiver, receivership or receiver. Can you define what that actually means in the commercial real estate world?
So in a foreclosure action, the lender is the plaintiff, obviously, and the defaulted borrower is the defendant, and the court needs an independent party to take care of the asset while the dispute is being fought out, whether the court's going to allow the lender to take title to it or not. And so that's where a receiver comes in. So they actually work for the court. Most people assume they work for the lender, and yes, the lender proposes who it's going to be, and they select who they want, but the court can do anything they want. But so you have to have this independence, this sort of arm's length relationship with both parties, and you effectively act as the owner of the property, making all the decisions an owner would make, more than just property management, leasing, capital improvements, all those things that an owner would definitely have a role in. And so for us, it's kind of fun because we have more liberty to do what we think is right for the property. Our philosophy is not just stop the bleeding and hoard the cash flow, but look at how can you maximize the value when eventually you exit, because 95% of the time the foreclosure goes through and the lender ends up having to dispose of it. So
Okay.
that's basically the role of the receiver.
Okay. And can you define REO? Because that term is used a lot and thrown around.
Yeah.
It's a relatively simple concept, I think, but you can just
Yeah,
define what that means.
it comes from banking. For whatever reason, they decided to call buildings that they own real estate owned, and some use OREO, other real estate owned. So, but typically what they mean by it is the real estate that isn't their business property. It's the real estate that they acquire by defaulted borrowers, being foreclosed on. And so there you don't have a receiver because that receivership ends when they take title. But most of the time, the receiver, if they're doing a good job, stays on as the manager until the property is sold.
Okay. Okay. And right now, with your investment firm, do you work with banks and offer services and solutions as kind of or are you focused solely on investment management and acquiring properties and improving them, et cetera?
Okay. So about about 2 months ago, when our last acquisition cratered because of the pandemic, um, we we've pivoted and revamped our receivership side because we had been very focused on investor managed properties and acquisitions that we then manage, with for our partners.
Right.
So our focus is we do work with banks, but most of our business has been, and we'll see how this cycle works, has been with what's called special servicers, who are the managers of defaulted loans that are collateralized mortgage-backed securities. Because in that case, the notes are owned by a bond pool, so there's no one there. So in the documents, they name a company that's going to manage it if it gets into default. So I'd say 2/3 of the receiverships have been with special servicers, and then another 1/6 or whatever with funds, and then the other with banks. So
Even before the crisis, there was always some people going into default and foreclosure. There's always a certain percentage, I would guess. Obviously, I would guess that's gone up dramatically now, but I could be wrong. Are you seeing just a lot of flow and a lot of actions already, or are you expecting that more in July, August, September as PPP money dries up for the people who got the 8 weeks of coverage? At some point, that's going to dry up for a big swath of companies, or people are just going to run out of dry powder. 25% capacity after being at 0% with some of these companies is not going to be enough to make payments, perhaps. What's your read on kind of what's going on right now?
So nothing's happened on the borrower side yet, really. The lucky ones have been able to negotiate a forbearance with their lender, say 1 to 3 months, just like homeowners have been able to get that on their home mortgage.
Right.
But so there's that. So that's helped. Although out of my whole portfolio, it's only happened on one building that we were able to get a forbearance. So it's not common. But the way I see it, lenders aren't ready to take that step to take ownership of the property, because nobody knows where the bottom is, and nobody knows what the world is like after that, particularly with retail.
Right.
Where are the retail sales? Retail is going to be, there's going to be retail sales. That's not a question. But where are they going to be? Are they going to be more online, less than brick and mortar, curbside? All those questions have to be answered. So, and you're right, the tenants have gotten PPP money and other sources. A good tenant, the rent is less than 10% of their normal gross sales. So it isn't the biggest item on their list of expenses. So ones that are capitalized pay the rent. In April we got between 60 and 70% of the rent, which is better than the industry, which is more like 40 to 50%. And that's all really a question of what kind of tenants you have. There's the mom and pop ones that may not have the capital, and then there's the big guys who are smart, and they go, this is an opportunity to go gouge the landlord. And so the middle ones pay, and these two parties you have to fight with to collect your rent.
Yeah, it's interesting when hearing you talk about that. I was thinking about how office parks have been hit pretty rough as well. There's self-storage, there's industrial, but I know we have our offices in a retail center. We're like basically in this retail strip mall area on Key Biscayne. And it's interesting, with investments you're looking at or are planning, do you see an arbitrage of taking these retail assets and making them into a self-storage asset, an industrial asset, an office asset, or you're more focused on making sure you have the blue chip anchors? They're going to bring the foot traffic to the other, retail centers, or is it really case by case on the property?
Well, already there's been conversion of retail space to office, like suite by suite, where you put a medical use in, or you have financial services and kids education, like mathnasium and things like that.
Sure.
And then you've got fitness, which isn't really a retail use either. So the industry's already been in this sort of transition of many types trying to focus on, okay, who's going to pay the rent, who's going to be solid, for the long haul. And I think that's going to change as we go through this whole cycle. There's been a trend in the last few years of going from the online to the bricks and mortar, and like Amazon's doing that, and Warby Parker, and you can go on and on the list, Best Buy, whatever. They
Right.
they get a dramatic increase in sales by having that focus on putting some brick and mortar up to for people to be able to feel and touch and see and all that. So I think one of the conclusions I've had already is we're going to focus on assessing the people with online presence and figuring out, the ones that are going to doing a good job and they're going to survive. Because I think with that cash flow from the online, it balances things out better and makes them a better quality tenant. So that's one of the things I'll be looking at as we go forward.
Okay.
Fitness, which was very hot, man, that's dead in the water in the pandemic because you got all these people together in a room sweating and breathing heavy. It's not going to happen. So those guys
Right.
fitness aren't paying rent. That's, they're just not paying rent because they're totally dependent on the membership fees.
Yeah. Yeah. Okay. Nobody has the right answer to this, of course, but you've got connections to, default rates. You're looking at industry data and commercial real estate and retail. How rough do you think this summer is going to get with just what we know at this point? We're recording this on the 22nd of May. So, something you say now is maybe different than someone hearing it a month from now or 2 months from now. But, states are all working on an opening up plan. Everyone expects there to be kind of a second wave or flare ups in different areas with the virus. But a lot of investors are just in research mode and they just feel like, wow, maybe it's going to get much worse. Should I even be doing anything right now with my money? And then others are like, well, I got to start investing now because if things correct, then we're going to miss our chance to invest. So kind of where's your team at on that spectrum? And like, what's your gut when you're talking internally about what's going to be happening this summer, early Q4, et cetera? What's kind of your consensus as a team?
All right, that's a tough one, but
Yeah.
the quick answer is it all depends on this fall and whether the virus comes back. But let's for a minute just say it's not coming back. Then, and backing up a step, in CMBS world, the default rate hit the low to mid teens, I think at the worst spot. Right now, they're officially, a couple of points, 1 or 2%, because it takes time for the loan, for them to stop paying for it, the file actually be moved to the special servicer.
Right.
Defaulted. So it doesn't show up in the stats right away.
Takes 10, 12 weeks to show up maybe.
Right. And, assuming the states are successful at reopening in the next month to 2 months, things shouldn't get too bad, assuming tenants come back and start paying their rent. The default rate won't be bad at all. But if we go into the fall, either we haven't successfully reopened or it failed, or if we come into the fall and the virus flares up, and we're riding it for a whole winter, I think that's when it gets ugly. Whether that's 10 or 15%, I don't know, but it's going to deflate people's expectations and hope, and I guess, and also with the lender side, they're not going to say, okay, well, tomorrow's going to be a better day. They're going to say, oh no, this is real trouble.
Sure. So you have this deep expertise in figuring out bad actor versus bad property. You also have this expertise in sourcing. You know how to talk to the banks to say, hey, I want to see what REO or OREO deals you have in your balance sheet that you're looking to offload right now, and you'll know who to talk to at the banks and how to talk to them, and then also how to digest the deals. I know you're focused on the Midwest. What else is going into your strategy, besides those moving components that give you a real edge over people that are just hoping they source a distressed real estate deal from somewhere versus having your knowledge and your system and your access? What else is going into your strategy in terms of focus or what you'll do with the asset after you acquire it, et cetera, that you could share here?
Okay. The advantage of being a receiver is I'm seeing the asset long before it goes to market for sale, right? It's in distress, so which means most likely you're going to be able to buy it at a good price. Yes, the best real estate isn't the first to go bad, but if you're undercapitalized or lose a tenant or two on a neighborhood strip center, even good properties can end up in that pile. So you got to use your all your due diligence knowledge and in my case the accounting knowledge to look at the books and figure out what's really happening there to decide, okay, this is really a bad actor problem. And then, is it a bad actor with a good property or a bad property? And a ton of them are just bad properties. It's whether they acted badly or not, they're just not good properties. And then the good ones, they're too good. They get snapped up before they even go into the foreclosure process. So the challenge for us right now at this point in time is it's been so long since the last crash that a lot of the people that we worked with are moved on, got promoted, whatever. So right now we're using this time to reestablish or make new relationships. So we're working with attorneys and accountants and directly with the lenders and the workout people and building a Rolodex that we can work with once the defaults are really happening.
Yeah, that's a great point. And that keeps on coming up on our discussion panels, on investor mandate interviews we're doing, is that a lot of people are using this time not to just develop an investment thesis, but renew that team or those tools or that Rolodex and plant seeds, whether you're trying to source deals or raise capital or invest as a family office. If you're not doing anything right now, you're not going to be able to get much done this summer or in the fall, perhaps, or at least not nearly as much. You might have to have 100 conversations so that you can actually be effective when you want to be effective, whether you're trying to allocate or source or whether you're trying to, raise capital. It seems like now's the time to be taking a lot of actions to get ready for a couple of scenarios unfolding that no one can predict, right?
Right, and we're on that capital front, we're assessing investor equity sources that have a higher risk tolerance. They're willing to step up to the plate before everyone else is comfortable. In many cases, that means paying real cash for the property because the lenders aren't ready to make loans. But that's where the best deals are. That's going to be the steepest discount because the group of bidders is going to be low or one, because there's not that many people that really can write checks. Obviously, family offices can, but a lot of individual investors don't have that capability.
Right. And what's the smallest size deal that you'll look at in this environment? Because I'm sure there's a lot of potential opportunities to look at. It takes a while to get your arms around it. I mean, what type of asset value dollar amount do you go down to?
It's easier to talk about dollar amount. And I'll just talk about what values were 2 months ago, because I don't know where they're going to be at, in a month or whatever. But basically 5 million to 50. I mean, you don't find that many assets that big. The last 2 deals we worked on were in the low 20s.
Okay.
So, and those were like 125,000 feet. We don't do big box centers. We stay in malls. We stay away from that because it's very difficult to be flexible with this big box. You can divide it, cost a ton of money. It's almost cheaper to rebuild it. Right.
Okay, makes sense. Great. Well, those listening that have a piece of deal flow where they want to trade notes or potentially co-invest or work with SL in some way, obviously you can reach out directly. Before we give your website or whatever's the best way to get in touch with USL, do you have any other comments you wanted to fit in for today on an outlook or an insight or a strategy that I didn't ask you about, perhaps?
My strategy is to be ready to buy and to just service. It's a profitable business and it just keeps you in the flow. So I'm hoping one feeds the other. and
Right.
that's the plan for now.
Sure. Okay. Great. And how can someone get a hold of Caprock and yourself if they want to trade notes, or they have a piece of deal flow, or just want to share thoughts on
Sure.
what's going on right now?
Our domain name is caprockre.com, RE standing for real estate, and sl@caprockre.com is my particular email address. So either
Okay.
way, you can find me on the website or just send an email.
Okay, great. And if anyone has trouble finding their website or getting a hold of SL, just let us know. He's been in the family office club for at least 2 or 3 years. I'm not sure how long we've been getting to know each other, but we've seen each other in person probably a dozen times now, right?
Yeah, yeah, yeah.
Wow.
It is a family.
Right. Yeah. And I appreciate you being part of it and contributing the thoughts here today. A lot of people are trying to figure out, based on different scenarios happening, who to trust or how to navigate that and what they should be doing right now in real time when there is so much that's unclear. So I think a lot of people will find this helpful, especially going out on the podcast as well. So appreciate your time here today.
Oh, no problem, Richard. Thank
Yeah.
you.
Take care.
All right. Bye.
Bye, Sal.